Okay, well, I'm not going to buy any trucks next year. What happens?
Right.
However, the way I see it is that you would rather take the deduction now and pay the taxes next year and the year after, because the deduction provides me cash that I can put into marketing or something else that's going to expand my business.
This is the PMP Industry Insider Podcast.
Hello and welcome out to another episode of the PMP Industry Insider Podcast, where we look at what is changing in the pest and lawn industries, and we take you to the front lines to those who are driving those changes. I'm Donnie Shelton, owner of Triangle Home Services, which has Triangle Pest and Triangle Lawn. And with me is Mr. Dan Gordon. Dan, would you like to say good morning? Introduce our sponsors, talk a little bit about our awesome peer groups and our topics and our wonderful guests.
Sure. So you know, every time Donnie mentions our wonderful guests who they are, but you go through the list first. Dan Gordon from PCO Bookkeepers and M&A Specialists. We focus on the pest and lawn industry for CFO services as well as exit planning and whatnot. Sponsors, if you're interested in marketing for your firm, it used to be just digital marketing, but now it's all around marketing, websites, digital strategy, businesses scaling smarter. That would be Coalmarch, and that's coalmarch.com/PMP industry insider to claim a free month of service from them. If you're interested in insurance for our industry, general liability, auto, workers' comp, EPLI, all kinds of insurance, that would be peshure.com. And if you're interested in really transformative voice services, not just telephone, but solutions, including AI, that would be Voice for Pest. Learn more at voiceforpest.com/podcast. And if you're interested in accountability as an owner, you can join one of our
Sign me up, right?
Yeah. That's just what you need, some accountability. But quite honestly, we should take a minute and just kind of talk about it. But if you're interested in one of our peer groups, which has really grown quite nicely, it's pmpindustryinsider.com/peer groups, or go listen to episode 136 where David Billingsley, our facilitator, is running these peer groups, which I think I find them to be extremely interesting. It's not people like Donnie or David or I just spouting and trying to teach things. It's each other holding each other accountable, and also solving some of the common.
Listen, I learned some things I see happening. We obviously have a communication platform, and these companies are talking amongst each other, and I'm somewhat of a creeper in that I get to see these conversations, and some of them are quite interesting, and they're pretty cutting edge, and folks using AI, CSRs, people, just really some innovative things that I'm seeing. And so I guess my point is that it's not the usual week to week blabbering that you hear Dan and I do. It's more about learning together, and of course, once you get in your group, they tend to play off of each other. And the accountability thing that Dan talked about at the beginning, I think is obviously key and critical, especially as owners, because there's usually no one holding you to that kind of standard. But I love the interaction that's happening, and really just watching some of these groups learn and grow and really tackle some of the big issues that we have in our industry. So it's kind of
the neat thing is that they don't compete again. Like, so if you're in one of the peer groups, you won't have somebody from your market, so you can share information, something new that you're doing. But the accountability it's the embarrassment factor, right? You have to come to the meeting, and if you haven't done what you said you're going to do, or at least tried, it's like not doing your homework and going to school. So,
and I have to say that I have a very fragile ego, and I cannot stand going to a meeting and having to report bad news, which Dan will tell you that I get really frustrated with that happening.
Donnie is in one of our peer groups, and I can't remember the last time he came with good news. So
But
Uh,
in any case,
anyway, so
such is life. Such is life.
yeah.
So
So today we have two very special guests. That's Donnie and I.
we want
And
to emphasize the word special there.
yes,
But yeah,
very
keep going.
special need. Right. So, uh, so anyway, the topic that we're going to discuss. So on July 4th, the big beautiful Bill Act was made into law, signed into law, and represents one of the most significant overhauls of the U.S. tax code in recent history. The legislation enacts a wide array of changes, making permanent many of the temporary provisions of the 2017 Act, and we'll talk about that, while introducing some new deductions and altering taxation of both individuals and corporations. So,
Listen, I had to say this at the very beginning, which is
yes.
this. Listen, you can talk about Washington all you want, but they are the best. I mean, the very best at naming things. Do you remember the Inflation Reduction Act?
Mhm.
And now we've got the
No,
the big beautiful
this
Bill
is
Act.
Donald Trump at his best with marketing, right? I just want one big beautiful,
One big beautiful bill.
and it took on a life with that name. It really
it,
did.
it most certainly did.
That's totally Donald Trump. There's
Oh
no question
gosh.
about it, whether you
All
like
right.
him or don't. But
Yeah.
that's
Yeah,
his
and I'm not
thing.
listen, I'm not weighing an opinion either way. It's just hilarious how these things get packaged and branded, and next thing you
Yeah.
know, we're talking about an act that kind of says a little bit about what's in the title, but not really.
Yeah. So there's a lot of political issues that we can discuss within the bill, and that's not really what I wanted to talk about today. I wanted to talk about the tax aspects of it
Right.
because that's what's really going to affect you no matter what your political beliefs are.
And I'll bring in a little bit of the operational side. I mean, obviously, I'm not an accountant, and don't claim to be.
Yeah.
I know one. At least I think I do.
Ah,
But I can talk a little bit more on the operational impacts of this act
yeah.
as well. So I think that'd be
So
good.
there was a tax act in 2017 during Trump's first um, uh, term in office, and that was enacted. But most of the provisions were temporary. And when he did it, it was kind of like, yeah, well, that's way out in the future, so that's okay. Well, the future's now, right?
Right.
And all of those, um, uh, provisions were set to expire. Most of them were set to expire at the end of this year, 2025, right? And so, even though this is a massive piece of a legislation that really helps business owners with, reducing their taxes and whatnot, quite honestly, you're not going to feel much because it was already there. However, if they didn't pass it, you would have felt it going the other way,
Right.
right?
Mhm. Yeah.
So we're going to talk about a bunch of things that, okay, ho hum, but again, if they didn't do this, it would have, it would have impacted your tax situation. So,
In a negative way.
yes,
Very
yes,
much in a negative way. Yeah.
yeah.
All right.
So basically, back in 17, they, tax bracket, our tax system is graduated. So the less you make, the lower percentage you pay of your income, right?
Yeah,
And
we would call this the opposite of pay for performance, but keep going.
right,
Yeah.
right. So, well, so what happens is that they're bracketed. So from one amount to another amount, you pay one percentage, and then it climbs and whatnot. And in 2017, it took the top rate down from, I think it was 39 and a half to 37 and a half percent. Not a big deal, but that's for people who are making. I think at the time it was over 600,000. Now it's indexed, so it's over 700,000. But so what it did is it made those permanent. So it maintained these seven tax brackets. Uh, and that's going to help you quite a bit if you ask your accountant. But again, you're really probably not going to notice it. But this is the biggest part of the legislations, and it made those tax permanent, right? So it's not okay. We'll give you another 8 years, but that doesn't mean that the next administration that comes in or an administration after that can't go back and change it because that's what always happens. But right now, you don't have this looming date of, oh gosh, what's going to happen. And so it makes planning a little bit easier, for your future. So one of the big things that if you look at all the headlines, and I don't know how much this really affects us, is we'll go into a bunch of the aspects that kind of that are becoming permanent and whatnot. But one of the big things is this elimination on tax or on tips and overtime pay.
Mm.
And that's, does that affect us as business owners? Not so much, but it might affect our employees who get tips and who, we pay overtime too. Okay.
Right.
So you can deduct your tip income. The deduction is $25,000 annually. I don't know if your technicians earn that. I know with a lot of these.
Well, listen, this is not, it sounds like, a lot of people think tips aren't a thing in our industry, but they absolutely are, especially with the advent of some of the newer softwares that are out
Exactly.
there.
That's where I was going with it.
Yeah.
Yeah. So
It does have an impact,
mhm.
and even more so than our staff. I mean, there's also customers, right? I mean, if you're in an area where let's just say your demographic slants more towards, I wouldn't want to say like the lower side, but certainly folks who they earn part of their income probably through commissions or hourly, and then there's this other section that gets tips. I mean, they technically and theoretically it should be a benefit for that segment of the market, and it should allow more income in with your customers. And so, if you think about it, the increased child and standard deduction, benefit for middle household incomes, and then you've got this whole tip and overtime deduction that ultimately is going to result in more take home pay, right, for these types of potential customers. And so ultimately, I mean, the idea is that they have more disposable income. So,
And it's not a bad deal, right? So
no,
your first $25,000 of tips are not subject to tax. However, if you earn more than 150,000, then it gets phased out. So who would that be? Maybe the waiter at a really fancy restaurant. I don't know.
I,
I'm trying to.
I listen, sign me up. I mean, I would wait staff at that, right? I mean, that's, if you're running out of that tip because you're bumping that 150 thing, then I would say you're in a pretty good spot
Yeah.
overall.
So the overtime deduction is capped at 12,500 for singles and 25,000 for married couples. But it also phases out. But remember, it's not the overtime that you're not paying taxes on. It's that half time, right? So the time and a half, or if you're working on Sundays and your company pays you double overtime, right? It's the incremental off of the
Standard,
standard, right?
right?
So
Yeah.
um, let's see. Oh, very important. Both tips and overtimes are still subject to FICA, which is your Social Security. And I believe that's 7.65% that you would pay on that. And your employer also pays the other half of that. So it's interesting when you think about a paycheck. If you're the guy receiving it, if your employer pays you $50,000, it's probably costing him somewhere around 70,000 with all in, benefits and payroll taxes and whatnot.
Yeah.
So
What I want to do is I want to get to what I consider to be one of the biggest things, and I know you're going to get to this, which is depreciation and the impacts for this year. I mean, we're recording this in July, and if you're, I don't know when it's going to air. It's going to probably air sometime in July, if not in the very beginning of August. But now's the time when we start making moves, right? You're going to start. I mean, I would assume that most our listeners are going to start doing projections through the end of the year. They're going to start making decisions based on what taxes are going to happen. And this one is a big one, right? I mean, this one
before we go into this, the other really big one, this is the one that everybody lost their mind over in 2017, was state and local taxes, or they call it SALT, right?
Yeah.
Because prior to the 17 Act, you could deduct all of the taxes that you paid, but it was subject to something called AMT, or alternative minimum tax, so it was limited.
Mm-hmm.
But basically, if you're in a state where your real estate taxes are high, and then you have a state, tax on top of that and a local tax on top of that, your you could deduct those as an itemized deduction. What happened in 2017 is they limited it to $10,000, right? And so what did that do? So if you live in a state like Florida or Texas, not much, you don't have any income taxes, although you might have some hefty real estate taxes on your home and whatnot. But if you lived in a state that had high taxes, so New Jersey, Massachusetts, California, where you have really high real estate taxes, but you also have really high income taxes, state income taxes, you really got screwed by the 2017 Act, right? And so what this does is they went back and forth and they raised it from 10,000 to 40,000. They did it for 5 years. That one is a temporary one, but that cap is also phased out. So somebody who's really wealthy like Donnie, that would that would get phased out. So that's kind of
Uh-huh.
an irrelevant
Yeah, yeah,
deduction
for
for
sure.
him.
For sure.
Uh,
So let's yeah, I mean, so again, if you just catching in, I mean, the main thing there is that, raising that cap is I mean, I think that's pretty beneficial actually.
Well, raising the cap is beneficial. However, the deduction is reduced by 30 cents for each dollar of your what they call modified adjusted income. And so it reduces the deduction back to $10,000 for anybody earning over 600,000,
Mm,
which a lot of our listeners may or may not be in that bracket, but we have a lot of listeners who are.
mhm.
So before you start,
Before you do the victory lap.
right,
Yeah, it's
you
not quite.
understand.
Yeah, if
Yeah,
you're over 600K, don't
yeah,
get too excited.
yeah. Don't get too excited.
Yeah, yeah.
Um, Child tax credit that was increased by $200 a year. It's not really a big deal. I guess maybe it is, maybe it isn't. You also got just for being old or over 65, which to me is still old, right? Um,
You're
you get a,
fooling no one,
you
Dan.
get
That's
a, you
good.
get an extra $6,000. I have a few years to wait for that one, but
Uh-huh.
you
Yeah.
get a $6,000 deduction.
Yeah.
And there's also, it's kind of interesting. So when you think about taxes or you learn about it in accounting programs and whatnot, taxes do a couple things. They raise revenue for the government to do whatever they're going to do, but they also affect public policy. So that's why you put big taxes on cigarettes and liquor and
Mm.
stuff, because you want to control people and not have them do those kinds of things. One of the things that I don't like about this bill is it puts some, limitations on charitable giving, right? And so those who would give, because you get a tax deduction, so the government helps you. Some of those, you have to pass a certain threshold to get any benefit from charitable giving. And I'm not sure why they did it. I know that there was a lot of abuse with charitable giving. Who's
I,
actually,
I that's got to be my guess. I
yeah.
mean, obviously, I wouldn't sit in there. No one consulted me, but that has to be the because otherwise, it's like, why would he even bother that? And um, but I to me, like, I do you remember what is it? Was it a 0.5% or like what's that number? Do you remember like there's like the floor, right? That you've got to.
Yeah. So there's this standard deduction that you get, and we'll talk about that, or you itemize your deductions, right? So there's certain things in itemized deductions where you got to meet a floor, like medical
Mm-hmm.
and whatnot. Well, charitable giving is it sets a contribution at a percentage of your adjusted gross income before it even kicks in the itemized deductions. Uh, Giving to charity is not as there's still if you give enough, there's still a deduction for it, but it's you don't get as much bang for the buck as
Right.
you used to. Okay, and I do think that that's because of some of the abuse.
Right.
Then
As do I.
there's something that at first I looked at it, I was like, big whoop. They're called Trump accounts. So basically, it's a tax advantage savings account that when you have a newborn, the government uh, puts $1,000 into an account, right? Okay, big whoop, right? However, it grows like a Roth IRA, meaning that the income on it is not taxable or grows tax free. And you can put $5,000 a year into that account for your child. It's not deductible, but the income grows tax free. If you put $5,000 a year in for 18 years plus the thousand, and you put it into, the S&P 500 or whatever, that number could probably grow to close to $200,000, which I don't know what a college educational cost in 18 years. That might be enough to buy a couple of books if they're still
Yeah, I was gonna say it.
books. But but it's a lot of money, right? So
It is.
that one's actually pretty cool. So and then distributions can be made starting when the child turns 18 for higher education, first home purchased, or to start a business. That's pretty
And
cool.
that's crazy when you
That's
if you
pretty
think
cool.
about it. I
Yeah.
mean, it's essentially tax-free money if your child decided to start a business. It's
Yeah. So
awesome.
so that's one of those arguments like where geez, some people want to forgive student loans, but then there's those who didn't go to school and have these big debts who started a business. And hey, why don't you forgive the loan that I took on a dump truck to start my construction business or whatever? And so this seems to, I think, address some of that, right? And I think that that's actually pretty cool. So that is all on the individual side. Now we can go to the
The fun stuff. I
businesses.
I consider to be fun
Uh,
stuff, which is the depreciation.
so this is well before that the permanent the corporate tax rate, which came way down from the 2017 and will remain permanent, is now 21%. So you say, well, geez, I could be a C corp. Well, you don't want to be a C corp because it's 21%, because when you distribute the money, then it gets taxed again. What you'd want to
Hmm.
be is a pass through, like an LLC, or an S corp, or a partnership taxed as an S corp. And the reason that you want to do that is because you don't get taxed at the entity level, you get taxed at your personal level. However, remember what I just said before, your maximum uh, bracket is 37 and a half, but then you say, geez, well, if I were a C corp, it would only be 21%. But there's this thing called the QBI deduction. And that is you get to exclude 20% of your income, your entity level income. And so it kind of puts the C corp and the S corp on the same playing field.
Hmm.
So that's been made permanent. And that is one of the ones that we surprise a lot of clients with each year. Geez, I thought that I made all this money. How come I'm not paying all the taxes? Well, because we took the QBI, right?
Hmm.
So um, let's see. Um, yeah, so let's talk about depreciation.
Yep.
So there's something called bonus depreciation, and that allows you to you can write off it. Bonus depreciation can drive you into a loss position, so you can actually, let's say you made $100,000, you buy a few trucks, and that cost 150,000. Now you got a $50,000 loss that you can offset against other income, right? The 179 deduction that has been around for a while. You can do the same thing, but it can't create a loss. If it does create a loss, it gets pushed forward it's suspended until you have the income. So the bonus depreciation is extremely beneficial to our industry. And so you wanted to talk about doing some tax planning and
Yeah. Well, I mean, I think the main thing here is that, if you're, because it doubled as well, right? I mean, it went from like 1.25 to 2.5 for like the 179. Am I making that up? Does that sound right to you?
yeah, no, it's based on the amount of money that you spend on the
Right.
not the deduction itself, right?
Right.
So,
But you
so
can
the
expense that. I mean,
oh
you
yeah.
can, so there's that, right? I mean, number one is that, okay, so you just got that doubled. The second thing is that, and again, I am not, I want to be careful how I say this. A really wise man once told me, don't spend money to not pay tax. And that is 100% true. So before I say this, remember that key point. Don't spend money to save tax. However,
Says the
if
man with two airplanes.
if you need to get rid of,
Yes.
or there's something that you need to buy, this is a fantastic strategy, because what it allows you to do is, okay, I can go out and buy the equipment now and I can get a tax benefit from it. I might as well go ahead and use it. And so, and listen, we've talked about this several times on the podcast. It was certainly a strategy I used early on. Eventually, if you're not there already, you'll get to a place where this will help, but it's certainly not going to
It's a double-edged sword. So we have some
correct.
clients who are like, okay, well, I'm not going to buy any trucks next year. What happens? Oof,
Right.
that, and that's, however, the way I see it is that you would rather take the deduction now and pay the taxes next year and the year after, because the deduction provides me cash that I could put into marketing or something else that's going to expand my business.
And the other part of this, and this, I think a lot of people take this for granted, is this is now. This is what I know is going to happen right now. I don't know what's going to happen to tax law next year. It might get extended. Who knows, right? But for me, when it comes to taxes, I view it as like, the promised day off. When I was younger, I'll never forget this. I was like 18 years old. I was in the military. They can't give you bonuses. They can't do anything like that, right? And so I'd work all these extra hours, and I'd work Saturdays. And my boss, his name was Sergeant Jones. He's like, Donnie, I kept accumulating these days off. And that's how you got bonused in the military, is like, hey, you got a personal day, right? Well, the problem happened was this. I had almost 30 days of these personal days banked up. And then my boss got moved. Guess what happened?
Guess who lost his
All those
personal
days moved.
days?
I was like, what? I go to my new boss. I'm like, hey, I got a personal day. He's like, I don't know what you're talking about.
Yeah.
So my point here is that, listen, if
Give
the
me
tax
10,
environment,
soldier.
yeah, I will never forget that. I'm like, lesson learned. And buddy, if I got like a personal day, it was like the very next day I'm out, right? I mean, it was like I took it right then. So my point here is that, when you've got these tax benefits that happen, to your point, Dan, take them, right? I mean, you can obviously move things forward if you need to, but you never know what the tax environment's going to be the next year or the next couple of years. And so when you have to recoup that, like you said, hey, I don't have any trucks to buy. Well, then you deal with that problem then. I'm not telling you to be foolhardy. I'm not telling you don't think and only make decisions about today. I'm just simply making a point. If there's a good deal, don't assume that good deal is going to be there in 2 years or
Right.
5 years or whatever.
And
Because
and
it
and
may not
listen,
be.
if you're gonna do that, take the money and spend it on a vacation or,
Right.
something crazy.
Yes.
Well, that's not crazy. But if you're gonna do that, right, then expect in the next year you're not gonna have that deduction left because you took it all this year.
Right.
But like I said, if you take it and you have the cash and you put it into something that's going to help grow your business, that's like the government funding your
Your
growth,
growth.
which
Hmm.
is really, really powerful.
Yeah. Yeah. No.
So, couple other things there. So, the if we talked about that salt tax going up to 40,000, but if you're over 600,000, then it goes back. But not to fear, because there's something that we do for all of our clients and has been done since the 2017 Act. It was kind of started by a lot of the high tax rate states called the pass-through entity tax.
Mm-hmm.
It's kind of unfair to non-business owners because they can't get any benefit. But if you're a business owner, what you can do is you can pay your taxes at the entity level, your state tax, and that reduces your income that flows to your personal tax return. So, if you pay a 10% tax on your entity to your state, well, that lowers your taxable income for federal purposes. So you get that SALT deduction anyway, right? And so what this has done is it has made these PTE taxes permanent. Permanent for now. All of this is permanent for now, right? Until
Right.
another administration comes.
Right. And can come back in and back it all out.
Yeah.
One thing about I know that we're talking about, I want to come back to that depreciation and the whole 179 thing. One other thing to add to that I forgot to mention is that, there's going to be another 3 to 3.5 trillion added in debt, which is going to drive our debt to GDP above 120%. What that means for you and for me, the person that's out there, in the small business making it happen, is that interest rates are probably going to go up, most likely, because people aren't going to really want to lend to the U.S. I'm not saying we're insolvent and there's this whole
They're already starting. Yeah.
But I mean, my point is that, some countries are going to be like, I don't know, man, these guys are spending and no plan to get out of it. Like, I don't, for me, it's like, if I laugh when my kids lend money to each other because they're like, well, he's going to pay me back. I'm like, they're borrowing money from you because they can't manage their own money. So anyway, but my point here is that the real impact for you is this. I believe, and I'm not just saying this, I believe that future interest rates are going to go up. The days of 3 and 4% on home ownership, those days are gone. I think the days on, like as far as what we're seeing with vehicles. So put it all together, you've got this nice depreciation. You've got interest rates right now that are not, that, again, I don't think they'll ever go back to where they were 5 years ago, but I don't think they're going to go down. So kind of put those two pieces of information together, which is, if you've got a purchase to make, if you want to, I would, again, I'm not encouraging you to spend, but I'm just saying things to think about because I don't see interest rates going down. So I just wanted to throw that. I forgot to mention that when we were talking about the 179 exemption. And it's more than trucks, right? I mean, can I do that? I mean, I can do that with like equipment. Can I do that? Can I do that with equipment, Dan?
Yeah.
Yeah.
Any equipment, everything has, so the bonus depreciation allows you to take up to 100%. So if you're buying termite rigs and
right,
the thing is we don't, but if you're a lawn care company, you buy big trucks, you buy Z spreaders, you buy, so there's definitely some benefit in that. So it's not just trucks.
Right. Okay, cool.
All right.
Anything
Last
else?
one.
We're getting close to the end here.
Is interesting, especially for those selling your company, right, or their company. So this is one that everybody was afraid that was going to expire because prior to 2017, the amount that you could exempt from gift and estate tax was very low, right? And then the tax, the 17 Act raised that. It was like $12 million. And then if you're married, so it's 12 million each or 24 million. Now it is at $15 million. So if you're a married couple, it's 30 million, and it'll be indexed. And so that is huge when you're thinking about what's the next plan. If your company's worth, $50 million or something, you get a $30 million exclusion from the estate and gift tax. Or if your company's worth 10 million, there's no estate or gift tax. So,
and let me add to that what I just mentioned before, Dan, and I'm not trying to stump you when I ask this question. If lending rates go up, traditionally, what does that do to values of businesses when money is a little bit more difficult to get a hold of?
Well, the asset goes down. You're paying more in interest,
Yes,
right?
that's exactly that's
yeah.
you passed, right? And that's exactly
Thanks,
my
man.
point, which is, if I am as a buyer have to pay more for the capital to purchase your business, it's a zero-sum game. That's less money that I can put into the deal because at the end of the day, I have to make the numbers work. Right. So those are other things. And by the way, I'm not telling you to go sell, sell. I'm not Jim Cramer, and I'm not smacking some button, although I think Dan is. But in any case, I would say, if this is something that you're considering, something else to think about, right? You have this exemption. It's a pretty good tax environment to do it. I don't see, maybe values will go up. Who knows?
No,
Right?
I actually I was at the club this weekend and had a pretty heated argument with a guy who's a financial advisor. And he's like, Trump's got to lower the taxes. And Trump is banging the drum to lower the taxes. But at the end of the day, if he lowers the taxes, what's that going to do to property values? We're talking about mortgages. It's going to increase property values. Like you said, it's a zero-sum game.
Zero-sum game.
Increase and oh, by the way, when you go to sell, it's higher, but you get to deduct all that interest. You don't get to deduct the value of your personal residence. If you make a profit on it and it's over a certain amount, depending on whether you're single or married, you could owe tax as a capital gain on your homes. It's a pretty high number, so most people won't. But if you lose money on your house, personal residence, you can't deduct it, right? So
tough. Exactly. All right. Well, listen, Dan, this has been fantastic. Again, the big, beautiful bill. Yes. I think we've gone through it. Of course, I'm sure. Don't call me if you've got questions about this thing. Call Dan. This is his lane, not mine. But I would say for me at least, this has certainly got me thinking through purchasing some equipment, I might add, and it's got me thinking through like what am I going to do for the end of the year? And I think it's a good time for everyone to be thinking about that. Especially, so point being, understand what's in the act, understand what's coming down the pike, and also, I would. It's starting now is when you need to start thinking about what 2025 tax is going to look like, and then how to get yourself set up for 26.
By the way, we're starting all of our projections right now with all of our clients. So yeah. It's not too early.
And it's time to do it now, because if you need to make moves, you got to have time to get the equipment, right?
Yep.
That's the big thing. So, all right. So reminder, all the resources and topics that we talked about today are available on the podcast website. Just take a look at pmpindustryinsider.com. Take a look under show notes. Marisa does a fantastic job of summarizing, and I know that she really struggles with the episodes. It's just Dan and I, because we ramble quite a bit. And we always appreciate any ratings and reviews that you have, so long as they're positive. If they're negative, we ask you to pass that to Dan. He absolutely loves negative feedback. And with that, we're going to sign off. We'll see you next time. Take care.
Thanks so much.
Bye now.